Okay, this is a little bit longer problem. I've got a lot of the numbers here, so we'll just walk through it. This is just kind of got everything in it, so let's just talk about it. We kind of do this in parts, talk about what we need to spend first, and then the savings, and then we talk about the net working capital required. So let's look at this. So this is a project that costs $10 million. It's going to last for 6 years, and at the end of 6 years, you'll still have some value in the equipment. You estimate that will be $2 million, so you'll sell it for $2 million at the end. So right away you can see, okay, I'm going to sell this for $2 million. I'm going to have to figure out the book value and pay taxes on it and see how much of that $2 million I get to keep. The equipment will be depreciated over 6 years, so that's good. The book value at the end will be zero, so you know that makes this a little easier. You're just going to have to pay taxes on the whole $2 million. Tax rate's 35%. So the initial investment required is $10 million to buy the machine. We figure out what we're going to do at the end. We know that 6 years from now we'll sell it for $2 million, but we'll have to pay 35% of that in taxes. So the net we're going to make out of this is $1.3 million. Realize that's 6 years from now. We'll get $1.3 million from selling the machine. All right, yes, year 0, year 6. Okay, so if we're trying to keep track of our cash flows here, then we've figured this out right away, right at the start. Spend $10 million today, we'll get $1.3 million back 6 years from now. Right? Then we have to talk about what happens in the middle. This says the investment will allow you to sell 750,000 pounds per year at a price of $20 per pound. You expect the revenues to go up with inflation at about 5% a year. So you can figure out how much that's going to be. The first year you're going to make $15 million. Okay, that's $20 per pound at 750 pounds. And then this is going to increase 5% a year. So you can see I'm just increasing my revenues by 5% a year. And I would do that for 6 years. So I've calculated the first two here. You'd also calculate 4, 5, and 6 the same way. Right, so you'll have those revenues. So I've listed them out here. Okay, and then you'll also have expenses. The first year will be $10,000, and then they're also going to increase by 5% per year. So list those here. 10,000, and then I'm just increasing by 5% a year, multiplying times 1 plus 5% for the next 5 years. Okay. All right, now let me mention here this problem. I actually copied this problem from an old textbook, and it's a little strange in that this problem, you operate the equipment till the end of year 5, and then the assumption is that it takes you about a year to find a buyer for the equipment, right? So you operate the equipment and you collect all these revenues and expenses, and then in the 6th year you sell it. Okay, so it's a little bit strange in how these cash flows work, but that's just what we have here, so we're going to go with it this way. All right. So it's going to be straight line depreciated over 5 years. So that's $2 million a year. So we're also going to have that depreciated by $2 million a year. And if we calculate all of this out, we will have our revenues, expenses, depreciation, the line here, pre-tax profit. That's what we've been calling EBT. Right? That's the same thing as earnings before taxes. We calculate the taxes. Calculate the profit. The profit and net income are the same thing. So this line is just net income. I took pre-tax profit minus the taxes. Gives me net income. And then I add back depreciation to that. That gives me my operating cash flows. Right? Now, we also have working capital in this case. And in this case, they didn't tell you it requires an investment up front of so much, and that's it. They tell you how much working capital is required every year. So they give you these numbers. This is the amount that we think we're going to need in working capital each year. Now in this case, what you have to do is remember that, okay, well, it's the change in net working capital that affects cash flow. So I've got to calculate the change in these numbers. One thing to remember here is that the change in year 0 is 1.5. You went from 0 to 1.5, right? Also, the change over here is minus 3.0. I don't know why I rounded a little different here, but minus 3.038. 8 or 9. I'm sorry about the rounding there, but I just made a mistake. But you went from having this much net working capital to 0, so that's a change of minus that much, right? Now, again, don't get confused here. These are the actual changes in net working capital. Their effect on cash flow is going to have exactly the opposite sign. So this is reducing your cash flow by 1.5 and then reducing your cash flow by 2.5. And then when these numbers turn negative, that's actually adding to your cash flow right out at the end. You're getting that. One way I think about it is you're winding this project down, and so you're reducing the amount of extra stuff you need for it, and you get all of that money back. All right. Okay, so I've got it all laid out here in a table here of exactly how we calculate all these things. And what you have to figure out now is, okay, what is my total cash flow? So for instance, in year 0, I have to spend $10 million to buy the equipment, but I also have to spend $1.5 million on net working capital. So my total cash flow at the beginning is minus $11,500,000, right? And then in year 1, I'm going to get this much from operating cash flow, but I'm going to need this much. I'm going to spend this much on net working capital. So I have to take operating cash flow minus the amount of net working capital to get my total cash flow in this year. And the same is true here. Let's look at year 5. I'm going to get this much from operating cash flow. I'm also going to receive this much. Since net working capital is smaller, it's adding to my cash flow. So I'll take this minus a minus, so it gives me a positive change in net working capital, and that'll be my total cash flow in this year. All right, and then remember, you also get in cash flow 6, you get the 1.3 million from selling the machine at the end, and you get this much from getting the net working capital back. Right? So we're going to have to come up with the total cash flow to put into our cash flow button. Don't forget the one at the end or the net working capital at the beginning. All right, so if you put those in, I think I have them here. Yeah, there's my total cash flow every year. That's going to be what goes in your cash flow button. I forget what the discount rate is, but it's included in the problem. 12% return. Put these in your cash flow button at a 12% return. You'll get a $4.22 million net present value for this project. Okay, all right, that's the end. So I encourage you, particularly that last problem, work through it, make sure that you can come up with all those problems, come up with that correct net present value, and be ready for the exam.